Okay, I want you to take a second here.
Sure.
And try to really visualize what it actually takes to steer a multi-billion-dollar heavy metal behemoth.
Oh man, that is quite the mental image.
Right, and I am not talking about, standing on the bridge of some 100,000-ton nuclear-powered aircraft carrier and turning the wheel.
Though that would be pretty incredible.
It would be. But I mean, steering the actual massive, sprawling, historically entrenched corporation that physically builds those carriers.
Yeah, that's a whole different level of steering.
Exactly. So welcome to today's deep dive. Our mission today is to decode the freshly released Q2 2026 earnings transcript from Huntington Ingalls Industries.
Ticker symbol HII.
Yes, HII. And we're going to try and unpack what might genuinely be one of the most complex manufacturing supply chains on Earth.
It really is. I mean, you're talking about a scale of industrial output that most of us, we just never encounter it in daily life.
Never. Because we aren't talking about, writing scalable software code here.
Right. Or assembling consumer electronics where you can pivot your entire product line in a month if you need to.
Yeah. If you make a mistake with a smartphone, you push an over-the-air update.
Exactly. But here, we are talking about bending thousands of tons of steel, managing tens of thousands of specialized workers, and operating on these production timelines that don't just stretch across quarters, they stretch across entire decades.
Which is why this data we have in front of us today is just so vital.
Absolutely. When HII releases an earnings report, it really serves as this de facto State of the Union address for the entire American naval industrial base.
It does, because they are the sole builder of U.S. Navy aircraft carriers.
The only one. And
one of only two builders of nuclear-powered submarines.
Right. So they basically are the industry.
Yeah. So when you have CEO Chris Kastner and CFO Tom Steele getting on a call with Wall Street analysts, every single decimal point matters.
It really does, because those decimals represent billions of dollars and literal national security assets.
Exactly. So we're going to act as your personal translators today, turning all this dense Wall Street and Pentagon jargon into clear, actionable insights for you as a retail investor.
And there is a lot to get through.
So much. Yeah. We've got our standard roadmap for you today. We're going to hit the headline numbers and then the fascinating story driving those numbers.
Including a really massive strategic shift in how they actually build these ships.
Yes, that part is wild. Then we'll look at management's guidance and finally the actionable bottom line. What this actually means if you're holding or eyeing this stock.
It's going to be a fun one.
So let's just dive right into section one, the headline numbers.
Let's do it.
Looking at the sheer velocity of the growth this quarter, the momentum is, it's aggressive.
Very aggressive.
Second quarter sales hit $3.4 billion.
Wow.
Yeah. Which is a 10.9% increase year over year.
In the heavy defense sector, approaching 11% top-line growth, that is a massive signal of systemic health.
Right, because it's not a software company.
Yeah, exactly. A software company can double its revenue by, acquiring a new user base overnight with practically zero marginal cost.
Just flipping a switch on a server.
Right. But for HII to grow top-line revenue by nearly 11%, it means they physically had to push significantly more raw material components and labor through their dry docks than they did 12 months prior.
You can't fake it.
No, you can't. It requires this massive synchronization of the supply chain and human capital just to hit that number.
And what caught my attention is how it flowed directly to the bottom line.
Earnings per share.
Yeah. Diluted earnings per share skyrocketed to $5.27.
Up from what, $3.86?
Exactly. $3.86 in the exact same quarter last year.
That's a huge jump.
It is. And I always zero in on the diluted EPS rather than the basic EPS.
Right, because it's the more conservative metric.
Exactly. For anyone listening, diluted EPS assumes that every single convertible security, every outstanding stock option is fully exercised.
So it gives you the worst case scenario.
Right. The absolute worst case scenario for your slice of the profit pie. So seeing a roughly 36% jump in that diluted metric, it means the core cash generation engine is running incredibly hot right now.
It really is. And the executives on the call, they made sure to highlight exactly where that engine is housed.
Because it's not all equal.
No, it's not. HII basically operates through two primary shipyards and then a third technology-focused division.
Okay, let's break down the shipbuilding first.
Right. So the core shipbuilding numbers are robust. They pulled in $2.7 billion in revenue for the quarter.
Out of the 3.4 total.
Exactly. And that $2.7 billion, it marks a 15.7% year-over-year increase.
15.7% in shipbuilding.
Yeah. But more importantly, this represents their fourth consecutive quarter of double-digit growth in the shipbuilding segment alone.
See, that sustained growth implies a real structural shift. You don't hit 4 consecutive quarters of double-digit expansion by accident.
No, you don't. That's a trend, not a fluke.
So breaking it down geographically, you've got Ingalls Shipbuilding down in Pascagoula, Mississippi.
Right.
They generated $845 million, which is a 16.7% increase.
And they focus pretty heavily on amphibious assault ships, right?
Okay, amphibious assault ships and the Arleigh Burke-class destroyers.
Yeah, okay.
Then you look up at Newport News Shipbuilding in Virginia.
The heavyweight division.
The heavyweight.
Yeah.
They handle the nuclear-powered aircraft carriers and the submarines.
How did they do?
They brought in $1.8 billion, which is a 15.3% jump.
So both yards are essentially moving in lockstep.
Complete lockstep.
Which is great. They're moving together, driven by higher volumes across both carrier and submarine construction. But...
here's the but.
Yeah. To understand the full financial picture, we also have to evaluate their third segment.
Mission Technologies.
Right. Mission Technologies. Revenue there posted at $760 million, which is actually a 3.9% dip compared to last year.
Yeah, I saw that dip. And honestly, on paper, seeing the core business surge while the tech segment shrinks, it could trigger some anxiety for anyone holding the stock.
Definitely. Looks like a red flag at first glance.
But diving into CFO Tom Steele's commentary, it looks like a classic accounting distortion.
Right, rather than an actual operational failure.
Exactly. Steele addressed this directly on the call. He said that last year's Q2 for Mission Technologies included this non-recurring contract resolution.
A one-time thing.
Yeah, a $45 million one-time cash injection from settling a historical contract dispute.
Gotcha. So it artificially inflated last year's numbers.
Precisely. If you strip out that $45 million anomaly, Mission Technologies actually generated modest organic growth this quarter.
That makes total sense. Furthermore, their operational efficiency improved drastically.
Oh, the margins. Let's talk about the margins.
They posted a 7.2% operating margin for the Mission Technologies segment this quarter.
Which is really solid.
It is, especially considering it's a substantial leap from the 4.6% they posted in the exact same period last year.
Wait, 4.6 to 7.2?
Yeah.
Wow. So the division is highly profitable and executing well, despite the headline revenue number looking artificially deflated.
Exactly. The year-over-year comparison is just messy because of that settlement.
So when I step back and look at these cumulative numbers, the $3.4 billion in sales, the surging profitability, the sustained shipyard growth, it feels less like a company making minor quarter-to-quarter adjustments.
Right.
It feels more like a nuclear reactor spooling up.
Oh, I like that analogy.
Think about it. The initial inertia required to just get the baseline temperature up, to train the workforce, to secure the supply chains, it's immense.
You burn so much capital just to get the system active.
Exactly. But once that thermal momentum is established,
the power output is staggering.
And incredibly hard to disrupt. I mean, they spent years laying this groundwork, and now the reactor is operating at critical mass.
That is the perfect way to frame it, because the capital expenditures required to build a naval fleet are heavily front-loaded.
Very front-loaded.
So when you witness this kind of sustained growth today, you are actually observing the delayed realization of strategic decisions made 2, 3, or even 4 years ago.
A financial momentum is a lagging indicator.
Right. It's a lagging indicator of physical, operational momentum.
Which brings up the most pressing question, and really leads us into section 2 of our deep dive, the story behind the numbers.
Right, because you don't physically manifest a 15.7% jump in shipbuilding revenue without actually moving more metal.
You can't spreadsheet a destroyer into existence.
No, you certainly cannot.
So how do they achieve this on the ground? What does this mean for the actual people, the thousands of workers wearing welding masks and hard hats?
Well, the executives leaned heavily on one specific metric to explain this.
Throughput.
Throughput. It is the ultimate arbiter of success in heavy manufacturing.
And for anyone unfamiliar, how would you define throughput in this context?
It basically measures the rate at which a system generates its final product. So for Huntington Ingalls, throughput dictates how rapidly and efficiently they can convert raw steel, copper cabling, and complex electronics into a commissioned warship ready for the Navy.
Okay, and the numbers they shared regarding throughput they're striking.
What did they report?
They announced a 12% improvement in throughput compared to 2025 year-to-date.
12%.
And they are targeting a 15% improvement for the full year.
Wow.
I mean, I have to imagine that finding 12% more efficiency in a century-old manufacturing process is just brutally difficult.
Oh, it's incredibly difficult. It requires systemic, structural changes in how the work is actually executed.
Because you can't just yell at people to work 12% faster.
Right. You cannot squeeze 12% more productivity out of a workforce simply by demanding longer hours. You achieve it by fundamentally altering the working conditions and the labor dynamics.
And the primary driver of this throughput surge seems to be a massive influx of human capital.
The hiring numbers.
The scale of their hiring is just hard to wrap your head around. Management stated they have hired over 3,500 shipbuilders so far this year.
3,500 in 6 months.
Yes. That is a small municipality's worth of people that they've onboarded, trained, and deployed onto the shipyard floors.
It is a phenomenal logistical feat, but honestly, it's also an absolute necessity.
Why is that? Because of retirements?
Yes. The broader defense industrial base suffered a severe brain drain during the post-COVID period. We saw this massive wave of highly skilled, older workers just retire.
They just left the industry.
Exactly. And when you lose, say, a master shipfitter with 30 years of muscle memory and intuitive problem-solving skills.
You can't just replace them with a 19-year-old kid off the street.
You cannot.
Yeah.
You can't simply replace them with one new recruit. The institutional knowledge loss requires overhiring just to maintain baseline productivity while the new workforce matures.
That makes the labor relations strategy they discussed incredibly vital, especially at the Ingalls Shipyard in Mississippi.
What happened there?
So, Brian Blanchett, the president of Ingalls Shipbuilding, he detailed this collective bargaining agreement that they finalized with their union partners back in March.
Okay, the new union contract.
Yeah. He called it a win for the workforce, the company, and the Navy. But he specifically noted its immediate impact on retaining what they call first-class craftsmen. And I really want to emphasize why this matters. Because a first-class craftsman isn't just an employee with, a few years on the job.
Not at all. A first-class craftsman is the absolute backbone of the shipyard.
Right.
These are the master electricians, the senior pipe fitters, the highest-level structural welders. They perform the most complex, critical tasks.
Like what? What are we talking about?
We are talking about executing X-ray quality welds while crammed upside down in a compartment deep inside a ship's hull.
Sounds miserable.
It takes years to master. And beyond their own physical output, these first-class craftsmen function as the informal, on-the-ground trainers for those 3,500 new hires.
Right, because the newbies have to shadow someone.
Exactly. So if you lose a first-class tradesman to a competitor, your overall throughput plummets.
Because the error rate goes up.
The error rate of the junior workers spikes massively, and rework is the enemy of throughput.
Rework just kills the timeline.
It kills the timeline and the profit margin.
And CEO Chris Kastner backed that up entirely on the call. He noted that the most efficient thing for the business is keeping a first-class craftsman employed so they could roll seamlessly from a finished destroyer directly onto a newly started hull.
Right. No downtime.
The efficiency gains of an experienced crew moving from one project to the next are massive. So negotiating higher wages in that March agreement, it's likely paying for itself.
Oh, absolutely. By neutralizing the hidden costs of attrition, recruitment, and rework.
Exactly.
It stabilizes the entire production floor. But, financial compensation is really only half the equation when it comes to retention in heavy manufacturing.
That's the other half.
You also have to evaluate the physical environment.
Oh, man. And this was my favorite detail from the entire call.
The shade.
The shade. It sounds so basic, right? But it reveals the gritty reality of this industry.
Tell them what Blanchett said.
So an analyst is pressing him on retention strategies. And Brian Blanchett brings up shade. He says they have invested major capital into putting over 1 million square feet of the Pascagoula shipyard under cover.
1 million square feet.
Under a roof, just to block the sun.
And you really have to contextualize the environment in Pascagoula, Mississippi during the summer.
I can't even imagine.
The ambient temperature regularly hits 95 degrees.
With like 90% humidity.
Easily. Now, put yourself in the boots of a welder in July. You are encased in heavy, flame-retardant leathers and a heavy protective helmet.
Yeah.
You are operating a torch that generates thousands of degrees of heat. And you are standing on a solid steel deck that has been baking in the direct sun for 8 hours.
So the ship itself is just an oven.
The ship becomes an unbearable heat sink.
The physical toll on the human body in those conditions must be extreme.
You'd be fighting heat exhaustion constantly.
Which means mandatory frequent breaks, right? For hydration and just core temperature recovery.
Exactly. Productivity naturally flatlines during the hottest parts of the day. You just can't work.
But by investing the capital to construct a roof over 1 million square feet of that workspace,
You alter the physics of the environment.
the steel remains cooler.
The ambient temperature drops. The workforce requires fewer recovery periods. Their cognitive focus improves.
And precision increases.
Yes.
So shade in Mississippi isn't a luxury perk. It's not a ping pong table in a break room.
No, it's a quantifiable mechanism for expanding profit margins.
It translates directly into that 12% throughput improvement.
It does.
Yeah.
But even with 3,500 new hires and 1 million square feet of shade, they are still pushing against physical capacity limits.
You can only fit so many people in a dry dock.
Right. Which introduces a major strategic pivot they discussed on the call.
Distributed shipbuilders.
Distributed shipbuilding. They are aiming to increase this practice by 30% this year.
Okay, so I want to talk about this because historically, a shipyard would lay a keel in a dry dock and construct the vessel from the bottom up.
Entirely in one location.
But that traditional method monopolizes a massive amount of physical real estate, right?
And it creates cascading bottlenecks. Think about it. If the team fabricating a specific internal module falls behind schedule, the entire ship waits. The whole timeline stops.
So I initially thought of distributed shipbuilding like snapping massive Lego bricks together.
That's a good visual.
But looking closer at the complexity, it's more akin to modular software architecture applied to a 10,000-ton physical asset.
How do you mean?
Well, HII is partnering with Gulf Coast fabricators. Companies like Bayou Metals and Halimar Shipbuilding.
Okay.
These partners aren't just sending over raw steel plates. They are building fully functional, self-contained nodes.
Like whole sections of the ship.
Exactly. They construct an entire machinery room block, complete with its own internal plumbing, structural integrity, and wiring, all off-site.
It creates a parallel production path.
Yes.
They barge these massive completed modules over to Pascagoula, where HII's heavy lift cranes literally hoist them into position to be integrated into the main hull.
And Blanchett noted they recently erected their first 2 ground blocks from these partners, and they integrated flawlessly.
Which is huge because by offloading this fabrication, HII massively increases their manufacturing footprint without having to acquire a single acre of new real estate for their own shipyard.
It is a brilliant expansion of capacity.
It really is.
And here is where I have to push back on the risk profile here.
What's your concern?
We are talking about the construction of nuclear-powered submarines and Arleigh Burke destroyers.
Right.
These are arguably the most complex, mission-critical machines in existence. Outsourcing a significant portion of this fabrication to third-party vendors seems to introduce catastrophic quality control risks.
Oh, absolutely.
I mean, if a partner fabricator cuts a corner on a structural weld, the consequences could literally be devastating at sea.
You're not the only one worried about that. The analysts on the call shared your exact concern. They aggressively probed management on the vulnerability of this outsourced quality control.
Because I would want absolute assurance they aren't just, emailing blueprints to a vendor and hoping a seaworthy module will arrive 6 months later.
Right. Hey, build this and send it back. No, Chris Castor offered a refreshingly candid response to this.
What did he say?
He acknowledged that HII has a long history of outsourcing, and he actually admitted they have, quote, unfortunately made mistakes in the past.
Well, that's honest.
It is. But what is vital for an investor to understand is how they have institutionalized the lessons from those mistakes. Blanchett emphasized they have totally abandoned the throw it over the fence mentality.
Okay, so how are they mitigating the risk of a third party building a piece of a destroyer? Because you can't just trust them blindly.
They don't. They treat the partner's facility as an extension of their own shipyard.
Like physically.
Physically. HII deploys its own engineering teams, its own quality assurance inspectors, and they coordinate with U.S. Navy inspectors to be physically present at the vendor sites.
So they have their own people on the floor at Bayou Metals.
Exactly. They conduct in-process inspections at every single phase of fabrication. Furthermore, HII maintains control over the engineering packages and frequently procures the raw materials themselves to ensure compliance.
Okay, so they're buying the steel.
Yes.
It's essentially Remote micromanagement.
Pretty much. They also mentioned starting vendors on a pilot range.
What is a pilot range?
Yeah.
Like a test project?
Yeah, they assign a small, low-risk fabrication task initially. If the vendor demonstrates they can deliver on cost, meet the schedule, and maintain pristine quality standards, HII progressively increases the complexity and volume of the work packages.
That makes a lot of sense.
It is a highly monitored, staged integration rather than a blind transfer of responsibility.
And that significantly lowers the anxiety around distributed manufacturing for me.
For the analysts, too.
So all of this physical throughput, all of these modules and new hires, they are entirely designed to service the contract backlog.
Right.
And this brings us to Section 3, the mega deals. Because this earnings call featured the finalization of a contract so massive, it reshapes the company's entire financial horizon.
It was the definitive headline of the call.
The announcement that an agreement had been reached on the Virginia-class submarine Block 6 and the upcoming Columbia-class submarine project.
Yeah. The scale of capital deployment in naval shipbuilding is just unparalleled.
It's wild.
These two submarine programs are the foundational pillars of the U.S. Navy's future operational strategy.
Let's break them down for the listener. So the Virginia-class is the premier fast attack submarine.
Right. It is highly versatile, designed for a broad spectrum of environments, especially littoral missions.
Let's define littoral for those who might not follow naval doctrine closely.
Good call.
We are talking about near-shore, relatively shallow water operations. It's a highly congested, acoustically noisy environment compared to the deep, open ocean.
Much harder to hide in.
Exactly. Operating effectively in littoral zones requires an entirely different, highly advanced level of acoustic stealth, sensor integration, and maneuverability.
And the Virginia-class provides that exact capability. Now, on the other end of the strategic spectrum, you have the Columbia-class.
Big ones.
The massive ones. This is the ballistic missile submarine program designed to replace the aging Ohio-class.
The boomers.
Right. The Columbia-class serves as the foundational, survivable leg of the United States nuclear deterrence triad.
So basically, these are programs that the Pentagon classifies as absolutely must succeed.
Failure is not an option.
And the financial numbers attached to these programs, which were confirmed during the Q&A portion of the call, are staggering.
What's the total value?
The total value of the contract modifications amounts to $76.6 billion.
$76.6 billion.
That single agreement represents a financial commitment larger than the gross domestic product of several sovereign nations.
It's unbelievable. However, we should clarify the structure of the submarine industrial base here.
Good point. Because HII doesn't capture all $76 billion?
No, they don't. HII's Newport News Shipbuilding division operates in a teaming agreement with General Dynamics Electric Boat.
So they divide the manufacturing workload.
Exactly.
Management actually broke down their specific allocation. Of that $76 billion total, roughly $25 billion flows directly to Newport News for their portion of the Virginia-class work.
Okay.
With an additional $5.5 billion earmarked for the Columbia program.
So from this single, newly finalized agreement, HII has secured roughly $30 billion in guaranteed future revenue.
$30 billion, guaranteed.
The finalization of this agreement provides what management termed critical demand signals and stability.
Which they desperately need.
Yes.
Yep.
In an industry defined by massive upfront capital expenditures, certainty is paramount. When you possess $30 billion in guaranteed multi-year backlog, you can confidently build 1 million square feet of shade.
Because you know you have the work to pay for it.
Exactly. You can aggressively recruit and train 3,500 new workers. You can sign long-term binding leases with those Gulf Coast fabricators.
It establishes a baseline of absolute financial and operational security for the entire supply chain.
It does.
Always a but.
There is a shadow hanging over this massive backlog, a phrase that permeated the Q&A session and serves as a really heavy anchor on current profitability.
Let me guess. Pre-COVID contracts.
Bingo. Pre-COVID contracts.
If you are analyzing the future earnings potential of Huntington Ingalls, understanding the historical pain of these pre-COVID contracts is mandatory.
It is the key to their margin story right now.
And analysts specifically requested an update on the ratio of pre-COVID versus post-COVID contracts currently sitting on the company's books.
Which is a very smart question.
It is, and I want to unpack the mechanics of this for you listening, because it explains why the company has struggled with margins recently. The core issue lies in the structure of defense contracting itself.
Because they aren't selling software on a subscription.
Right. These massive shipbuilding agreements are often fixed-price contracts, or they feature extremely rigid cost ceilings.
Right. So let's say HII finalized a contract to construct a destroyer in 2018 or 2019.
Okay, before the world shut down.
Exactly. They formulated their cost projections based on the macroeconomic reality of that specific moment.
So they locked in an assumed price per ton for steel.
A projected hourly wage for their labor force.
And they assumed a stable, predictable global supply chain.
Right. And then the pandemic fundamentally fractured the global economy.
Everything broke.
Everything. Supply chains completely seized up, which means critical components arrived months late.
Which stalls physical construction.
And drastically inflates overhead costs because the ship is just sitting there taking up space. Broad inflation skyrocketed, meaning raw materials like copper and specialized steel cost significantly more than those 2018 projections allowed for.
And the labor market underwent a violent tightening, forcing HII to raise wages dramatically just to retain a functioning workforce.
So, because those legacy contracts were fixed price, the Department of Defense did not simply issue a blank check to absorb the macroeconomic shock.
They didn't just say, oh, here's an extra $100 million for inflation.
No. HII was legally bound to absorb a massive percentage of those unexpected inflationary costs themselves.
That dynamic completely eroded and in some cases totally eliminated the profit margins on those specific vessels.
Those pre-COVID contracts literally became toxic assets.
They're legally obligated to dedicate dry dock space and precious labor to finish them, but they're generating negligible profit.
Basically doing the work at cost.
So when Wall Street analysts ask about the ratio of pre-COVID to post-COVID contracts, they are essentially asking, how much longer does this company have to digest these toxic margin-crushing projects before returning to historical profitability?
And CFO Tom Steele provided a highly encouraging, very specific timeline for this.
Did he give a date?
He indicated that by the end of this year, moving into 2027, the company will finally cross the 50-50 threshold.
The tipping point.
By the close of 2026, HII will hold more post-COVID contracts on their balance sheet than pre-COVID ones.
That is massive. This represents the ultimate inflection point for the stock.
It really does, because every time a newly negotiated post-COVID contract is signed, like that massive $30 billion submarine agreement or the newly awarded DDG destroyer contracts.
It is priced using contemporary economic data.
Exactly. It fully bakes in the current inflation rates. It accounts for the higher union wages established in the March CBA.
And it builds in the necessary supply chain risk buffers.
As Steele noted, these new contracts possess a, quote, much better balanced risk and opportunity set.
To synthesize the financial reality for the listener, every time one of these older pre-COVID ships completes its sea trials and physically departs the shipyard, a toxic contract is wiped from the books.
The bad debt sails away.
Literally sails away. And every time they lay the keel for a new vessel, a robust, highly profitable contract begins generating revenue.
It is a mechanical, structural expansion of their profit margins.
And they provided concrete examples of this transition happening right now.
Like at the Ted Stevens.
Yes. They highlighted the successful delivery of the DDG-128, an Arleigh Burke-class destroyer named the Ted Stevens, which sailed away in the second quarter.
That is a massive unit of completed work. The revenue is fully recognized, and crucial dry dock space is liberated for a newer, more profitable hull.
Exactly. They also emphasized the progress on the CVN-80,
which is the next Ford-class aircraft carrier. The Enterprise.
Yes, the Enterprise. They announced the vessel is now 64% erected.
Let's explain why they highlighted that specific 64% metric, because it might sound kind of random to an outsider.
Oh, it ties directly into the mechanics of percentage of completion accounting.
Exactly. When you are building a nuclear aircraft carrier that takes roughly a decade to construct, you cannot wait 10 years to recognize the revenue or collect payment.
The company would go bankrupt waiting for the check.
Right. Revenue is recognized incrementally, tied to verified physical milestones of progress.
So reaching the 64% erection mark unlocks specific, massive tranches of revenue and validates that the incredibly complex assembly timeline is functioning as designed.
They also noted that the CVN-79, the John F. Kennedy carrier, successfully completed builder's trials and is preparing for imminent sea trials.
Tracking toward a 2027 delivery.
Right. And sea trials represent the final, grueling phase where the Navy operates the ship at sea, testing every system to its absolute limits before officially accepting delivery.
Transitioning a carrier from builder's trials to sea trials drastically de-risks the project for HII.
Because the most complex phase of heavy construction is definitively complete.
Okay, so while the massive carriers and destroyers are paying the bills today and slowly shedding the financial baggage of the pandemic, I found the future trajectory of the company far more compelling.
Section 4, the tech frontier.
Yes, because while HII is publicly known as a gritty, century-old metal bender, they are quietly evolving into something entirely different.
And this brings us back to that Mission Technologies division we talked about earlier.
The one that looked like it shrank but actually grew.
Right. This division operates less like a heavy industrial manufacturer and more like a high-growth Silicon Valley startup embedded within a defense contractor.
It is a fascinating juxtaposition. Chris Kastner dedicated significant time on the call to highlighting highly advanced autonomous programs within this division.
He specifically mentioned the Romulus unmanned surface vessel.
The drone boat.
The drone boat. He noted it has advanced to the U.S. Navy's at-sea testing phase, which is scheduled for September.
And transitioning a drone boat from a theoretical concept or a controlled laboratory environment into actual open ocean testing. That is a massive validation milestone.
It proves it actually works in the real world. He also highlighted their underwater capabilities, specifically the Lionfish program.
Which is a UUV, right? A small unmanned undersea vehicle.
Exactly. A drone sub. Kastner noted they just secured the next production option for the Lionfish, and he proudly stated that their commercial variant, which is called the Remus 300, has successfully delved into the Navy's preferred next-generation UUV.
But, and this is where it gets really interesting for me, the physical hardware, the drone boat, or the drone submarine, is only a delivery mechanism.
Right.
The true value proposition lies in the software that commands it.
And they announced a major strategic partnership regarding this.
Yes, with Applied Intuition.
To develop AI-defined capabilities focused on manned-unmanned teaming.
Let's explore how manned-unmanned teaming actually functions operationally, because it completely redefines naval doctrine.
It really does. It changes everything.
The strategy is no longer about deploying a single, highly vulnerable aircraft carrier with thousands of sailors.
Nor is it about sending a rogue, isolated drone out to sea by itself.
Right. The doctrine relies on a manned asset, perhaps an Arleigh Burke destroyer or a Virginia-class submarine acting as the central command node.
And that manned command node controls an integrated swarm of unmanned drones operating in the air, on the surface, and underwater.
Exactly. Imagine a single human-crewed submarine deploying a dozen Lionfish drones to scout hostile waters, map minefields, or even initiate offensive actions, all while the manned submarine remains completely undetected and secure miles away.
And the AI software developed with partners like Applied Intuition is what actually makes this viable.
Because a human commander cannot manually fly 12 drones simultaneously with a joystick.
No, the cognitive load is too high. The AI handles the micro decisions: sea state stabilization, collision avoidance, swarm logic, and autonomous navigation.
While the human commander handles the macro decisions, like target verification and weapons release.
Now, an analyst rightly questioned the financial impact of this division on the call.
Yeah, I saw that. They pointed out that a drone submarine might cost a few $1 million.
Which is a rounding error compared to a $10 billion Ford-class aircraft carrier.
Right. So the analyst was basically asking, is this technology division genuinely a needle mover for a company of HII's scale?
Kastner's response was incredibly revealing.
He conceded that, in terms of raw, immediate top-line revenue, a drone swarm will not replace a billion-dollar battleship tomorrow.
It just won't.
However, he outlined 3 fundamental reasons why this division is hyper-valuable to investors right now.
First, it is unequivocally the fastest-growing business unit within the entire corporation.
Because the Pentagon's budget allocations for autonomous AI-driven systems are expanding exponentially.
Second, the demand profile is not restricted to the U.S. Navy.
Right, international sales.
There is a massive, immediate international pipeline as allied nations aggressively seek to acquire this scalable technology.
And the third point Kastner made is arguably the most crucial for the stock's valuation: profitability.
Margins.
These autonomous programs are typically structured as firm fixed-price contracts. But unlike a 10-year carrier build, they are dealing with modular manufacturing and software iteration.
The production cycles are measured in months, not decades.
Exactly. This allows for highly controllable, highly predictable, and very wide profit margins.
They can iterate software rapidly and scale physical production without the massive, inflexible infrastructure constraints of a dry dock.
You don't need 1 million square feet of shade to build software.
Exactly. It is high margin, highly scalable, and perfectly aligned with the Navy's overarching strategic pivot toward distributed lethality.
The Navy recognizes the inherent risk of consolidating combat power into a handful of massive, highly expensive, incredibly vulnerable targets.
If an adversary manages to sink a Ford-class carrier, it represents a catastrophic loss of human life and a devastating blow to strategic capability.
But if an adversary destroys a dozen Romulus drone boats,
it is a minor financial annoyance. You just launched 12 more.
Huntington Ingalls is strategically positioning itself to not only construct the giant vulnerable motherships, but to monopolize the production of the AI-driven drone swarms that will inevitably encircle and protect them.
It is an exceptionally intelligent hedge that ensures relevance regardless of how naval warfare evolves over the next 20 years.
It shows incredible foresight. However, while we can theorize about the next 2 decades of naval warfare, Wall Street is ruthlessly focused on the next 2 quarters of financial performance.
They always are.
And this brings us to Section 5, Management Guidance. Because this earnings call presented a highly technical, potentially alarming puzzle regarding a looming fourth quarter cash flow cliff.
This section of the transcript is dense, but it is the absolute crux of evaluating the short-term financial health of the company.
Let's start with the good news. Management took the rare step of actually raising their full-year guidance.
Which is wild because in the defense sector, management teams are notoriously conservative.
They heavily prefer to underpromise and overdeliver.
Exactly. So raising guidance is a definitive flex of confidence.
HII raised its 2026 shipbuilding revenue guidance by $500 million.
The new expectation sits between $10.2 billion and $10.4 billion for the year.
And beyond just revenue, they raised the floor of their margin guidance, now expecting a shipbuilding operating margin between 6.0% and 6.5%.
Increasing the revenue projection by $500 million signals that the throughput improvements we dissected earlier, the 3,500 new hires, the shade structures, the distributed modules arriving from the Gulf Coast.
It's all working.
It is actually materializing into physical, recognizable progress faster than internal models predicted.
And raising the margin floor confirms they are confident in the profitability of that accelerated progress.
Largely because they are successfully burning through those toxic pre-COVID contracts.
Right. So the revenue and margin projections look stellar.
There is a massive red flag buried in the cash flow data.
A massive red flag. And an analyst named Seth Seifman aggressively zeroed in on it.
We need to talk about free cash flow.
For any business, free cash flow is the ultimate truth teller.
It is the actual cash remaining after accounting for the capital expenditures required to maintain operations.
It's the money available to execute stock buybacks, pay dividends, or aggressively pay down debt.
And HII explicitly acknowledged they missed their Q2 free cash flow internal target.
They missed it. Compounding that miss, CFO Tom Steele projected that Q3 free cash flow would be incredibly anemic.
Generating only about $100 million.
Generating $100 million in free cash flow during a quarter where you post over $3 billion in top-line revenue. That is a jarring disconnect.
It is. But here is where the math becomes genuinely alarming.
Right. Despite the Q2 miss and the weak Q3 projection, management absolutely refused to lower their full-year guidance for free cash flow.
Which remains locked between $500 million and $600 million.
The arithmetic required to hit that full-year target is daunting.
It's terrifying.
I ran the numbers, and they're intense. If they only generate $100 million in Q3, they're mathematically required to generate roughly $1 billion in pure cash during the fourth quarter just to hit the bottom end of their guidance.
$1 billion?
I have to ask you, looking at this data, is management just relying on a fourth quarter Hail Mary? Is this an exercise in financial wishful thinking, hoping everything aligns perfectly in December?
From an outside perspective, demanding $1 billion of cash generation in 90 days looks like an insurmountable cliff.
It looks crazy.
However, Tom Steele meticulously broke down the structural mechanics of defense accounting to defend this projection. And when you analyze the mechanisms he cited, it becomes clear this is not a desperate Hail Mary.
Okay, lay it out for me.
It is a mechanical, predictable feature of federal defense contracting. Let's examine the 3 specific levers he identified.
I want to hear exactly how a company conjures $1 billion in a single quarter.
The first lever is working capital dynamics. In the defense contracting ecosystem, working capital naturally accumulates rapidly in the first half of the year and unwinds violently in the fourth quarter.
Break down what accumulates means in physical terms for the shipyard.
Consider the massive upfront financial burden of constructing a warship. Early in the fiscal year, HII is procuring thousands of tons of specialized steel,
laying miles of intricate copper cabling,
and issuing payroll for thousands of tradesmen. They are hemorrhaging cash to generate physical progress on the hull.
Right.
But due to the structure of federal progress payments, the Navy does not immediately reimburse that capital. The cash is functionally trapped inside the half-built vessel, sitting in the dry dock.
So that trapped cash is working capital accumulating.
Exactly.
They are essentially acting as a bank, fronting the capital for materials and labor.
Precisely. But as the year advances and heavily concentrated in Q4, the company crosses major contractual milestones.
Okay.
A vessel completes a rigorous phase of testing, or a massive distributed module is successfully integrated into the hull. Hitting those specific milestones triggers the Navy to release the accumulated progress payments.
Suddenly, all the cash that was trapped in the steel is unleashed back onto HI's balance sheet.
Steel explicitly noted that working capital expanded from 4% at the end of last year to almost 11% right now.
That represents a massive coiled spring of cash poised to be released as Q4 milestones are achieved.
Right, so that's lever 1, unwinding working capital.
What is the second mechanism?
Lever 2 is a highly specific anticipated tax event. Steel detailed that HII is expecting a massive IRS research and development tax credit to process and clear in the fourth quarter.
Okay, so it's a tax refund.
Basically. They have formalized the agreement with the IRS, the paperwork is traversing the system, and that check is modeled to hit their accounts before year end.
That provides a direct, non-operational injection of liquidity.
Yes.
So you have the working capital unwinding and a major IRS check clearing. But that still doesn't bridge the gap to a full $1 billion.
It doesn't. The third and arguably most significant component of the Q4 cash flow puzzle connects directly back to that $30 billion submarine mega deal we analyzed earlier.
The finalization of the Virginia and Columbia class contract modifications.
Exactly. When a contract of that monumental scale is formally executed, it triggers massive contract advance payments from the Department of Defense.
Advance payments?
Yes. The government essentially provides HII with a massive pool of upfront capital to immediately begin procuring long lead materials, things like specialized nuclear reactor components that take years to forge.
And to begin aggressively expanding facilities and hiring specialized labor for those specific hulls.
Additionally, formally signing the contract automatically unlocks various milestone incentives that HII had already technically achieved while the contract was being negotiated.
Oh.
Because the massive submarine contract was only finalized late in Q2, the resultant tsunami of advanced cash and unlocked incentives won't physically hit HII's bank accounts until late Q3 and heavily throughout Q4.
Exactly. When you synthesize these three levers, the structural end-of-year unwinding of working capital, the scheduled IRS R&D tax credit, and the massive influx of advance payments from the newly inked submarine contract, the $1 billion Q4 cash collection ceases to look like a desperate hope.
It looks like math.
It is the scheduled mathematical result of how these gargantuan defense contracts physically operate. As the saying goes in this industry, cash follows execution. Cash follows execution. That principle perfectly sets up the synthesis of this deep dive. Section 6, the bottom line.
Let's bring it all together.
We have analyzed a massive spectrum of data today, from 15% throughput targets and $76 billion macro contracts to million square foot shade structures and the nuances of working capital accumulation.
It's a lot to process.
It is. So let's distill all of this complexity into actionable insights. Based on the entirety of this earnings call, what is the ultimate verdict? Let's start with the bull case. Construct the argument for why an investor should view HII aggressively right now.
The bull thesis for Huntington Ingalls is built on a foundation of undeniable operational momentum.
Okay.
Primarily, you have the headline financial performance, 4 consecutive quarters of double-digit organic growth within the core shipbuilding segment. This is a historically slow-moving behemoth that has successfully shifted into a higher gear of production.
And executive management possesses enough conviction in this momentum to actively raise both their top-line revenue and operating margin guidance for the full year.
That is a definitive public statement of operational strength.
And their labor environment appears highly stabilized.
Crucially stabilized. They successfully executed a major collective bargaining agreement that immediately bolstered the retention of their most vital first-class tradesmen.
They are onboarding talent at an astonishing rate of 3,500 hires year to date.
And they are deploying massive capital into physical infrastructure like the shade structures to maximize the efficiency and safety of that workforce.
Furthermore, their strategic pivot toward distributed shipbuilding with Gulf Coast partners is successfully expanding their overall manufacturing capacity without requiring dilutive real estate acquisitions.
And from a financial risk perspective, they just secured massive stability.
$30 billion submarine contract.
They locked down a $30 billion allocation of a must-fail critical national security program. That establishes an ironclad baseline of guaranteed revenue stretching out over the next decade.
And, perhaps most vital for long-term margin expansion, they are finally crossing the threshold of shedding those toxic, unprofitable pre-COVID contracts.
The financial albatross of the pandemic supply chain shock is finally falling away.
That is an exceptionally strong bull case. It portrays a corporation finding its operational stride after navigating a brutal, multi-year macroeconomic storm.
But
complete analysis demands we examine the counter-narrative. What is the bear case? What are the specific risks you must monitor if you hold stock?
the bear case, or the primary cautionary flag, centers entirely on execution risk in the immediate future.
The Q4 cash flow cliff.
Exactly. The operational framework is solid, but the bar for success in the second half of this year is incredibly unforgiving.
Because of that required billion-dollar quarter.
We detailed the structural mechanics of how that cash is generated, but theoretical mechanics still demand flawless physical execution.
If a critical submarine testing milestone slips by merely 3 weeks in December,
or if a bureaucratic hurdle delays the IRS R&D tax credit paperwork,
that expected $1 billion of liquidity does not arrive in 2026.
And if HII misses that $500 to $600 million full-year free cash flow guidance, the market will severely punish the stock. They will entirely disregard the impressive top-line revenue growth. The margin of error for cash collection in Q4 is practically non-existent.
And regarding the labor force, integrating 3,500 new personnel seems inherently risky.
It is a massive vulnerability. The ongoing challenge is training and integrating those 3,500 raw recruits without cannibalizing overall shipyard efficiency.
Because it requires years of repetition for a novice welder to achieve the speed and flawless quality of a first-class craftsman.
Right. If the internal training pipeline bottlenecks, or if the rate of required rework spikes due to rookie errors, that targeted 15% throughput improvement will simply evaporate.
Synthesizing the bull and bear cases, what is the singular, actionable takeaway for the investor listening right now? If they hold this stock or are evaluating a position, what is the ultimate metric they should track?
The actionable takeaway is clear. The operational momentum and macroeconomic wins, specifically expanding defense budgets, and the strategic mandate for naval expansion are heavily favoring HII.
Right.
But the entire bullish thesis relies on one undeniable physical reality. They must execute on their stated delivery schedule. Management reiterated repeatedly on this call that they are committed to delivering 5 major vessels, including 3 originating from the Ingalls Yard over the next 12 months.
The physical delivery of those 5 ships is the ultimate arbiter of success.
Yes. If those 5 vessels successfully complete sea trials and physically depart the shipyards on schedule, it validates the entire operational model.
It proves the newly hired labor is effective.
It proves the distributed supply chain is holding.
Working capital milestones have been achieved.
And the $1 billion Q4 cash flow will materialize. If those delivery dates slip, the underlying financial arithmetic unravels. Watch the ship deliveries. That is your definitive metric.
Watch the ship deliveries. I love that framework. It slices through the dense accounting jargon and grounds the financial analysis directly in the physical, heavy metal reality of the shipyard.
Exactly.
We have traversed an immense amount of ground today, navigating from 15% throughput metrics and $76 billion mega contracts to the intricacies of working capital accumulation, AI drone integration, and the critical importance of 1 million square feet of shade in Mississippi.
It is a phenomenal case study of a truly unique, highly complex American corporation.
It is. But before we wrap up this deep dive, I want to leave you with a final thought to consider. Something that builds on the data we analyzed today, but looks further over the horizon. What is the parting thought for the listener?
Evaluating the intersection of HII's legacy shipbuilding and their mission technologies division raises a fascinating strategic question about the future of defense manufacturing.
Okay, what is it?
We just dedicated an hour to dissecting the staggering, monumental human effort required to construct a 100,000-ton aircraft carrier. We discussed thousands of specialized tradesmen, massive collective bargaining agreements, and the sprawling physical infrastructure required to bend that much steel.
It represents the absolute pinnacle of 20th century industrial capability, the ultimate expression of heavy metal manufacturing.
Yet simultaneously, HII is deploying massive capital into applied artificial intelligence and autonomous systems, like the Romulus boats and Lionfish drones.
Platforms that are endlessly scalable, relatively inexpensive, and operate completely independent of an onboard human crew.
Right. So the question we must ask is this. Are we currently observing the absolute peak of the human-crewed megaship era?
Oh, wow.
Looking 20 years into the future, will analysts still be scrutinizing union wage negotiations for thousands of shipfitters? Or will Huntington Ingalls be recognized primarily as a highly advanced autonomous robotics corporation, an AI software powerhouse that simply happens to manufacture the hardware that floats?
That reframes the entire narrative. Are we analyzing a legacy steel company, awkwardly learning to write code, or a cutting-edge software company preparing to completely disrupt the steel industry? It fundamentally alters how you value every capital investment they make today. Keep interrogating the data, keep searching for the physical reality behind the financial numbers, and we will see you on the next deep dive.